All right. The work that I'm going to be presenting today was conducted in Western Kenya in 2006 through 2009 and serves as the evidentiary foundation of this multi-country replication. But first, a little context. So there are hundreds of millions of micro-entrepreneurs in the world, but thus far, access to formal credit facilities has stymied micro-enterprise growth and development. However, theory has long suggested that savings, in the face of credit constraints, savings can serve as a reasonable alternative, even though the timeline of investments will have shifted. In practice and in observation, it's long been observed that savings is more widely practiced. In 2007, researchers Johnson and Jonathan Murdoch found that a bank in Indonesia had only a small percentage of its clients who accessed the loan facilities, but a much larger percentage were active savers. In addition, observationally, it's very possible that formal savings accounts may be of particular benefit to women who face regular demands on their income from relatives or neighbors who might ask to borrow it, or from their husbands who feel like they have a claim on it. In addition, in southern India, it was found that women actually use microcredit as a costly means of forcing themselves to save through the practice of weekly mandated repayments. And finally, there have been many studies, too many to name, that have shown that increasing access to savings accounts can have substantial impacts. In Mexico, Apertella found that the expansion of a bank into a new area that had low-cost savings accounts increased the savings rates of the entire area by 3 to 7%, and it was especially prominent for the lowest income households. So with such strong support for the potential benefits of savings accounts, one might have hoped that that current access levels would be higher than they are. But in this chart, which you're sure to see many more times today and tomorrow, access to formal savings remains quite low, especially in sub-Saharan Africa, where it's typically below 25% of all adults. In this table from the same data set, you can see that access does not necessarily translate into use. So in Uganda, for example, while 21% of adults may technically have an account, only 16% used it to save in the past year. In Kenya and Malawi, the figures are even more stark, where only half of the account holders had used it to save in the previous year. And finally, through ongoing work by the researchers, it's been apparent that coverage can be even lower in rural areas. So the question becomes, with such stymied access to formal financial institutions, and given the potential benefits, how has this impeded microenterprise growth over the years? And so Professor Dupas and Robinson approached this very question in Western Kenya. The study was conducted in 3 waves in 3 separate years, 2006, 7, and 9. And it was conducted at the same point of the year each year to try to control for possible seasonal effects. The total sample was in fact quite small. It's 250 individuals, of which 170 are women who sell small things and vegetables in the market, and 80 of whom are male bicycle taxi drivers, which in this part of Kenya are known as boda-bodas. The intervention was fairly simple. To a randomly selected treatment group, they were offered the chance to open a savings account at a local financial institution. Their membership fee was paid for, which was about almost $6.50 at the time of treatment. One salient characteristic of these accounts is that they were actually kind of a raw deal for the clients. There was no interest rate awarded on the accounts unless you reached a substantial sum of money, too big for this sample. And there were fees, there were withdrawal fees that increased with the size of the withdrawal you made. So the actual real interest rate on the accounts was negative. Data for the study consisted of 4 parts. First of all, the banking transactions observed over the first 6 months that the accounts were open. There was a baseline study, and there were games conducted to elicit time preferences and risk preferences of the sample. And finally, and most importantly, there were each participant kept a detailed daily logbook of their financial activities over the course of 3 months. These logbooks contain information such as their business investments and expenditures, home expenditures, transfers outside the household as well as within the household to their spouses. Here's an image of the village bank. It's called an FSA, a Financial Services Association. As you can see, it's not a very imposing structure, and that's quite by design. As you all know, someone who's new to the formal financial system can be intimidated by the formality and bureaucracy of a commercial bank. This FSA, on the other hand, was community owned and operated, and the client base was largely similar to the sample of the study. Also importantly for the study, this was the only formal financial institution within 25 kilometers of the study site. Okay, so just quickly some sample characteristics here. It was a moderately literate sample, and it differed by, I've separated it by the women and men. Interesting to note is that women especially have a high rate of participation in ROSCAs, or rotating savings and credit associations, at the time of baseline. This becomes important later on. And the average contributions that they made were not insignificant. They're over $60 over the past year on average. These women contributed. Men, of course, because there were so many, many fewer members, their average contributions were quite a bit lower. The average income in the week prior to the baseline survey was modest, of course, and to note, the male boater drivers earn quite a bit less income on average. And as you can see, there's a decent amount of informal lending going on, with 40% of the sample engaging in informal lending between friends and family, but quite a low level of formal loan taking. Okay, so the accounts were offered to 156 people, men and women, and about 13% declined to open the account. Further, 40% of the treatment group opened an account but never made a single deposit. So interestingly, there was a full 41% of the sample who used it quite actively, making 2 or more deposits within the first 6 months of the account being open. Now, these deposits on average were actually fairly large, so there's indication that women were saving up some money elsewhere before making these sizable deposits into the bank. Because just over half of the sample either had an account and didn't use it, or didn't have an account, of the treatment group, the median deposit amount was 0 shillings. However, and I alluded to this just before, it was really the women who were driving the account usage. As you can see, they deposited on average more than twice those of men. In fact, the men in the sample barely used the accounts at all. The researchers did some examination into the determinants, what made people take up the accounts and use them. And it turns out that a ROSCA membership is highly correlated with usage of the accounts, as is wealth. So that's an indication that those who use the accounts saw them possibly as a complementary saving service rather than substitutionary of ROSCA participation. The authors, in fact, found no evidence of money being diverted away from the ROSCAs and into the savings accounts. And of course, the wealthier ones were more likely to use the account, indicating that they were more beneficial to those with more resources. Saw a very interesting benefit in the form of increased business size as measured through the value of their inventory, or rather their daily investment in inventory. So this is that finding, and I'm going to preface it by saying that these numbers are, in fact, not statistically significant, but they are quite large. So why am I presenting this anyway? Well, there are a number of reasons why these results were insignificant. First of all, as I've noted, the sample was quite small. There's every indication that with a larger sample, they would have been significant. These are results just for the women. Just for the women. With the full sample, including the men who didn't use the accounts, the effects are statistically significant at the 10% level. So these results, these specific levels are not meant to be taken as gospel, but just as an indication of the benefits enjoyed by the women in the sample. So daily investment in their businesses, so these women going to the market and buying vegetables or small goods from a wholesaler to resell. For the control group, that was about $3.20. For the entire treatment group, the red column, it was about 38% higher, which means that for those who, if you look at only those who actively use the accounts, the green column on the right, they invested about 100% more on average per day in their business. Contrasted with this, it's interesting to note that there was no observed change in the type of business or the scope of their business. So there wasn't a lot of shifting going on. They didn't take on employees. They didn't change their labor supply. They were simply buying more goods from the wholesaler. There was also higher reported business revenue. However, that was extremely noisy and not significant. And finally, in terms of expenditures, there were 13% higher food expenditures and 38% higher private expenditures. Now, those are statistically significant. And private expenditures includes things like hairstyling, clothing, meals out, sodas, things like that. Okay, so given the results that I presented, what are the main takeaways? Well, you're welcome to form your own and read the paper, but let me just suggest a few to you. So clearly there's an unmet demand for formal savings services. Even with this disadvantageous savings product, it was taken up and used by a sizable percentage of the treatment group. And there was a clear benefit that was shown to using it. There were remarkably high returns to capital that was reported. And as I mentioned before, the usage of the accounts, the deposits were a bit lumpy. These women were not going to the accounts every day. So there is some suggestion within that women were able to shield their income from the demands of others. It's inconclusive, but it's worth looking into further. Clearly there are a lot of questions that come out of this study, including what's the generalizability of it and what happens if you let the accounts run for a longer period of time. So in 2010, the researchers sought to expand the study. The sample size was about 1,500 respondents. This is in the same general area in Kenya. The take-up and usage results, however, were quite different for this study. In this case, only 62% even opened the account, and of those 62%, and of those opened accounts, only 28% of those accounts were used more than twice, or at least twice, excuse me. So the question immediately became, why was usage so much lower? Well, it turns out in qualitative follow-ups that there was a high level of distrust of the financial services in the area. There was a history of financial scandals. In one of the three market areas, deposits were frozen while as a bank was undergoing a scandal. The services were deemed of poor quality. The bank was unreliable. It wasn't always open. The lines were long, etc. So the point of this is to show that regardless of the possible benefits of expanding access to savings, if we don't have good, high-quality, reliable institutions, any such gains will be modest at best. Okay, so this brings us to today, where there is ongoing work that I'm directly a part of that has been focusing on savings in Uganda and Malawi. We have over 2,000 participants at each site, and the time frame is much longer, as are the periods of data collection. We have 4 survey rounds this time. The scope of the surveys is also quite a bit broader. We're examining outcomes related to certainly business income, but also agricultural practices, responses to shocks, educational results, things like that. And of course, the results are forthcoming. So, in conclusion, the study presented by Professor Dupas and Robinson shows clear support of the benefits of expanding access to savings. And it's our hope to understand these mechanisms more through further research and provide clearer measurements going forward. Thank you very much.